Welcome to our channel. Today, we're diving into a topic that affects all of us: how raising interest rates controls inflation. You might be wondering, what's the connection between these two economic concepts? Well, let's break it down. Inflation is essentially the rate at which the general level of prices for goods and services rises, eroding purchasing power. When inflation gets too high, it can create uncertainty in the economy, making it harder for people to plan their finances. This is where interest rates come into play. When central banks, like the Federal Reserve in the US, raise interest rates, they make borrowing more expensive. This tends to slow down spending and investment, which can help cool off inflation. But why should you care? Understanding how interest rates impact inflation can empower you to make better financial decisions, whether you're considering a mortgage, saving for retirement, or just trying to manage your monthly budget. In this video, we'll explore the intricate dance between interest rates and inflation, and how these economic forces shape your financial landscape. So, stick around as we unravel these concepts and help you navigate your financial future with confidence. Understanding inflation. Inflation is a term that often comes up in economic discussions, but what does it really mean? Simply put, inflation refers to the rate at which the general level of prices for goods and services rises, leading to a decrease in purchasing power. One of the primary ways we measure inflation is through indices like the Consumer Price Index, CPI, which tracks the price changes of a basket of consumer goods over time. So, what causes inflation? There are two main types: demand pull and cost push. Demand pull inflation occurs when the demand for goods and services exceeds supply, often in a growing economy. On the other hand, cost push inflation happens when the costs of production increase, leading businesses to raise prices to maintain profit margins. Factors like rising wages or increased raw material costs can contribute to this type of inflation. Controlling inflation is crucial for economic stability. High inflation can erode savings, distort spending, and create uncertainty in the market, making it difficult for businesses and consumers to plan for the future. By keeping inflation in check, central banks can help maintain a stable economic environment, fostering growth and ensuring that your money retains its value over time. Understanding these dynamics is essential for making informed financial decisions. Role of interest rates. Interest rates play a vital role in the economy, acting as a key lever that influences borrowing and spending. When interest rates are low, borrowing becomes more affordable, encouraging consumers and businesses to take out loans for big purchases, investments, or expansion. This increased spending can stimulate economic growth, as more money circulates in the economy. Conversely, when interest rates rise, borrowing costs increase, often leading to reduced spending and investment, which can slow down economic activity. The relationship between interest rates and consumer confidence is also significant. Lower interest rates can boost consumer confidence, as individuals feel more secure in their financial situations and are more likely to make purchases or invest in homes and businesses. On the flip side, higher interest rates can create uncertainty, leading consumers to hold back on spending, which can further impact economic growth. Central banks, such as the Federal Reserve, play a crucial role in setting interest rates. They adjust rates based on economic conditions, aiming to balance inflation and growth. By raising or lowering interest rates, central banks can influence overall economic activity, helping to maintain stability. Understanding the function of interest rates is essential for grasping how they affect your financial decisions and the broader economy. Mechanism of control. Raising interest rates is a powerful tool used by central banks to control inflation, and it works through several key mechanisms. First, higher interest rates make borrowing more expensive. When consumers face increased costs for loans and credit, they tend to cut back on spending. This reduction in consumer demand helps to slow down the economy, which can ease upward pressure on prices. In addition to affecting consumer behavior, increased interest rates also impact investment and business expansion. Companies often rely on loans to finance growth projects. When interest rates rise, the cost of financing increases, leading many businesses to postpone or scale back their expansion plans. This slowdown in investment can further contribute to reduced economic activity, helping to keep inflation in check. Moreover, higher interest rates can strengthen a country's currency. As rates rise, foreign investors may seek higher returns on their investments, leading to increased demand for that currency. A stronger currency can make imports cheaper and exports more expensive, which can help reduce inflation by lowering the cost of imported goods. However, it can also impact export competitiveness. Overall, the mechanism of raising interest rates serves as a critical strategy for central banks to manage inflation, influencing consumer behavior, business investment, and currency dynamics in the economy. Understanding this process is essential for grasping how monetary policy shapes our financial landscape. Historical examples. Looking back at economic history, one of the most notable instances of interest rate hikes controlling inflation occurred in the 1980s. During this period, the United States faced soaring inflation rates, peaking at over 13% in 1980. In response, the Federal Reserve, under Chairman Paul Volcker, implemented a series of aggressive interest rate increases. At one point, the federal funds rate reached an astonishing 20%. These significant rate hikes had a profound impact on inflation. By making borrowing more expensive, consumer spending and business investment slowed considerably. As a result, inflation rates began to decline, eventually dropping to around 3% by the mid-1980s. While the economy experienced a recession during this adjustment period, the long-term benefits included a more stable economic environment and a return to sustainable growth. The lessons learned from these past economic policies are invaluable. They highlight the importance of decisive action in the face of rising inflation and the potential trade-offs involved, such as short-term economic pain for long-term stability. Additionally, this historical example underscores the critical role that central banks play in managing inflation through interest rate adjustments. Understanding these past instances can provide valuable insights into current economic strategies and the ongoing battle against inflation. Current economic context. As we move into 2024, the economic landscape is marked by ongoing challenges related to inflation and interest rates. Recent trends indicate that inflation remains elevated, with rates hovering around 4 to 5%, significantly above the target levels set by central banks. This persistent inflation has prompted central banks, including the Federal Reserve, to respond with a series of interest rate hikes aimed at curbing rising prices. In response to these inflationary pressures, central banks have adopted a more aggressive monetary policy stance. Throughout 2023, we saw several rate increases, with the federal funds rate reaching levels not seen in over a decade. These measures are intended to cool off consumer demand and stabilize prices, but they also come with potential risks, such as slowing economic growth and increasing the cost of borrowing for consumers and businesses. For consumers, higher interest rates mean more expensive loans and mortgages, which can lead to reduced spending power and a shift in financial priorities. Businesses, on the other hand, may face challenges in financing expansion or investment projects due to increased borrowing costs. The implications of these economic dynamics are significant, as they shape consumer behavior and business strategies in an environment where inflation and interest rates are closely intertwined. Understanding this current context is crucial for navigating the financial landscape ahead. In this video, we've explored the intricate relationship between interest rates and inflation control, highlighting several key points. We began by defining inflation and its measurement through indices like the Consumer Price Index, discussing how factors such as demand pull and cost push contribute to rising prices. We then examined the role of interest rates in the economy, noting how higher rates can reduce consumer spending and borrowing, ultimately impacting investment and business expansion. We also looked at historical examples, particularly the significant rate hikes of the 1980s, which effectively curbed soaring inflation and provided valuable lessons for today's economic policies. In our current economic context, we analyzed recent trends in inflation and interest rates as of 2024, emphasizing the responses of central banks to ongoing inflationary pressures and the implications for consumers and businesses alike. As you reflect on these concepts, consider how they influence your financial decisions, from loans and mortgages to savings and investments. Understanding the dynamics of interest rates and inflation can empower you to make informed choices in your financial journey.